Let's talk about systemic restrictions. And these are nothing more than added restrictions for the biggest banks in the world, the ones that are systemically important. Usually, these are just leverage ratios, liquidity ratios, and added regulatory capital demands. Let's take a look at the specific formulas and ratios. Due to the role of large institutions in the interconnectedness of the financial markets, which creates a high degree of systemic risk in case of failure if they implode, there are additional restrictions placed on larger institutions. The rationale here is that if one of these institutions goes bankrupt, the consequences are a lot more severe than for small banks. So there must also be stricter criteria to keep them safe. These restrictions include two types of regulatory capital restrictions: leverage ratios and liquidity ratios. So the first capital surcharge is the countercyclical capital buffer, or CCYB, and this is a surcharge of 0 to 2.5% of the risk-weighted assets total as regulatory capital on top of the existing 8% floor. And this buffer must be exclusively Common Equity Tier 1. So if the RWAs are 100 billion, this means 0 to 2.5 billion in addition to the existing regulatory capital. The second type is the G-SIB surcharge, or Global Systemically Important Bank Surcharge. As the name says, this is a surcharge for only banks that are considered G-SIBs, the most important ones in a worldwide sense. Banks like JP Morgan, Goldman Sachs, Citigroup, and so on. So G-SIBs are classified in 5 buckets depending on their size and interconnectedness, and they have an additional surcharge of 1 to 2.5% of their risk-weighted assets as an additional regulatory capital surcharge. Again, all Common Equity Tier 1 depending on the bucket. Out of curiosity, no bank reaches the top buckets, so in practice, only the buckets 2 to 4 are filled. No bank is ever in the highest tier of the surcharge, and that's the goal of the Basel Committee. In case a bank ever reaches the top bucket, a new one is created, because you never want a bank that is more interconnected and bigger than all other banks. That's the message that the Basel Committee defends. Then we have supplementary leverage ratios, or SLRs. These are additional ratios in specific of assets to equity. There are 3 different ratios which we'll cover depending on the institution size and importance. And finally, we have liquidity ratios. These are ratios that divide a bank's liquid assets or funding by their liquidity needs. As the name says, they tell you how liquid the bank is. There are 2 main types: a short-term one, which is the LCR, or liquidity coverage ratio, and a long-term one, which is the NSFR, or net stable funding ratio, which is not about the actual assets that are liquid, but the long-term sources of liquid funding. Let's start with the capital surcharges. The first is the countercyclical capital buffer, or CCYB. As the name says, this buffer has the point of providing an additional capital cushion to counter the negative part of an economic cycle. Although it's usually between 0 to 2.5% of the total RWAs, and that's on top of the existing 8%, please notice that the banking regulators have the discretion to increase this amount based on a myriad of factors, including asset prices, spreads, the bank's country's GDP, and others. So for example, if you have 100 billion in RWAs and the surcharge is 2.5%, the maximum, in your case, it's 2.5 billion. But your bank regulator, at any point, can call your senior management and say that due to the economic conditions, it's now 3.5, or it's now 4.5, and you have to accept that. Then we have the Global Systemically Important Bank surcharge, or the G-SIB surcharge. If the previous surcharge is due to the fragility of the economy, this one is due to the size of the institution. It's an additional capital surcharge of between 1 to 3.5% of RWAs. And again, that's on top of all existing regulatory capital. And if you're curious, yes, they do stack. So if it's a low point in the economic cycle and you are a GSIB, it is completely feasible that you need a 2.5% RWA or even higher buffer plus another 3.5% or even higher GSIB surcharge. This is normal. The rationale here, again, is that the biggest and the most important bank holding companies need increased resiliency, because the failure of a big bank such as JP Morgan would be so catastrophic to the entire world. We need all of these additional measures to make sure that it never happens. The Federal Reserve Board uses a specific formula themselves to calculate the amount for each GSIB. So one specific bank may have a 3.4% value, another one a 3.1% value. It all depends on the particular conditions and the result of the Federal Reserve's formula. Finally, after the Great Financial Crisis of 2008, leverage ratios were introduced, and the reason for these was mostly regulatory arbitrage. You probably know this by now, but what would happen is that regulatory capital is demanded for risk-weighted assets, so banks would move assets or reclassify them so that they would not be counted for the risk-weighted assets, so they would not be included in regulatory capital. But this meant that there were a lot of assets in a bank whose risks did not have cushions against losses. So leverage ratios precisely fight this. They are ratios between Tier 1 equity and all assets of a bank, whether they are risk-weighted or not. There are three major types of leverage ratios. The first leverage ratio, which always occurs, is 1 of 4% of Tier 1 capital to the total assets of a bank. And in specific, 3% must be common equity Tier 1. This includes, remember, both risk-weighted assets and all other assets. So if a bank has 100 billion in total assets, they need 4 billion in Tier 1 capital. And within that, 3 billion is common equity Tier 1, period. Then we have another leverage ratio just for banks that use advanced approaches for regulatory capital calculation, that is, internal models approaches. This is in contrast with the basic indicators or standardized approaches, which use external data from a table. So any bank using internal models has an additional leverage ratio of 3% of Tier 1 capital to their total assets. So in our scenario, if a bank has 100 billion in total assets and they use advanced approaches, they need an additional 3 billion of Tier 1 capital. And finally, unsurprisingly, we have an additional one for GSIBs, in the US in specific. So United States regulators impose on GSIBs an additional 2% Tier 1 capital leverage buffer. This is just due to their size or their role in the system. And this one in specific is known as an enhanced supplementary leverage ratio, or an ESLR. And again, it stacks. So if you're a GSIB that uses advanced approaches for regulatory capital calculation, so you fit all of these three, and most do, you need 4% of Tier 1 capital for starters, then an additional 3% due to using internal models, and then another 2% just due to being a GSIB. And the goal of all of these ratios is the same. It's to limit risky activities and assets in a bank, and to force them to have appropriate cushions. And finally, Basel III in specific, which came right after the Great Financial Crisis in 2010, imposed liquidity ratios on bigger banks. And this is due to the fact that reduced liquidity can easily cause a steep fall in the bank's ability to raise capital. Going deeper, as you probably know, banks engage in maturity transformation. They borrow in the short term to lend in the long term. They take short-term deposits to fund long-term loans. But the key here is that when a bank is in trouble, or at least there's the perception that it's in trouble, it just can't obtain funding, whether from depositors or loans with commercial paper. That's how Lehman Brothers went under, for example. They couldn't fund themselves because no one would lend to them. If they had liquidity, they may actually have survived the crisis, but they didn't. So these liquidity ratios guarantee that the bank has enough internal liquidity in case there is a big downgrade of their rating or significant withdrawals. With Basel III, we have two key types of liquidity ratios, one in the short term, the LCR, and one in the long term, the NSFR. The short term one is the liquidity coverage ratio, or LCR. It's a ratio for 30 days and it applies to banks with 250 billion or more in consolidated assets. This ratio is calculated by dividing the high quality liquid assets, or HQLA, that the bank has by the 30-day cash outflows in a stressed scenario. This ratio, naturally, must be higher than 1. These high-quality liquid assets are things like cash, central bank debt, or marketable securities. And as the name says, these must be highly liquid in case that a sale is needed. That's why the ratio must be higher than 1. That is, the quantity of the highly liquid assets must be more than enough to make up for the dramatic loss during the stressed period of 1 month. And it's important to understand that this period must be of acute stress, which includes all types of negative consequences: a downgrade of the bank's debt by 3 notches, withdrawal of a large quantity of deposits, and more. The goal really is to simulate a dramatic month and to ensure that the bank can survive all of this turmoil with their liquid assets. Then, for the long term, we have the NSFR, or the Net Stable Funding Ratio. It's a ratio concerning a 1-year period, and it's about long-term liquidity. And it's a ratio between the current stable funding sources divided by the required stable funding sources. So what happens is that on one hand, the bank has funding sources of liquidity: capital, retail deposits, wholesale deposits, and we attribute a liquidity rating to each. Then we take the items that the bank needs to fund the required liquidity themselves, and we attribute a rating to those as well. And we will have different weights for different funding types. For example, in terms of the available funding, Tier 1 and Tier 2 capital have a 100% weight. They're fully liquid. Stable deposits with under 1 year of maturity have a 90% weight. They're 90% liquid, if you will. Wholesale deposits are 50%, and so on. In other words, what we're doing is we're rating the liquidity of the bank's current funding and the liquidity of the bank's required funding. And the higher the ratio, the more liquid that the bank is in the long term. Just as with the previous ratio, this one should be higher than 1. What are some examples here? The first is that the FRTB, or Fundamental Review of the Trading Book, is another measure besides leverage ratios. As we mentioned, the reason for leverage ratios is that banks perform regulatory arbitrage. They figured that they could move assets from the banking book to the trading book to reduce the risk weights or even eliminate it. So the goal of the Fundamental Review of the Trading Book is to completely redefine which assets can be placed on the trading book and the banking book. It completely prevents regulatory arbitrage, and therefore it demands a lot higher regulatory capital, because you can't perform any type of arbitrage to reduce that capital. And unsurprisingly, banks are not very happy with this, and there has been some very violent pushback from them. Then, a lot of these measures were implemented in a uniform manner in the US, but not in the European Union, and this is due to a lack of political harmony and consensus across the member countries. It's also possibly because the United States felt the pain of the great financial crisis in their core, with 2 of their biggest banks going under, so their reforms were swift and efficient, mainly Dodd-Frank. Europe had to face multiple political landscapes from different countries. And finally, the high-quality liquid assets, or HQLA, are just for short-term survivability. You may ask, why is it that the liquidity coverage ratio is just for 30 days, and we don't just use it for months or years? Why do we use another ratio? And the reason for this is simple. It's costly to keep these liquid assets on the balance sheet for months or more. Remember, the more liquid the asset, the lower the returns. because a lot of investments have precisely an illiquidity premium. The longer that you lock up your money, the higher the returns. So this is why the LCR is used to calculate how a bank survives a short-term shock with liquid assets, but they're just for the short term. In the long term, we have the net stable funding ratio, which is about the funding sources. They serve different purposes for different timeframes. What are our key takeaways this time? The first is that there are 3 types of additional restrictions for systemically important bank holding companies. There is a countercyclical capital buffer to fight downturns. There is a surcharge for G-SIBs, just for being one, and there are supplementary leverage ratios, or SLRs, for all. First, both the countercyclical buffer and the G-SIB surcharge are additional risk-weighted asset percentages to be added to the existing ones as regulatory capital, and specifically in terms of Tier 1 capital. Then, leverage ratios come in multiple formats, and they are the ratio of total assets to Tier 1 capital. There are 3 relevant ones: a global leverage ratio for all banks, another one for banks that use the advanced approaches to calculate regulatory capital, and finally, one for G-SIBs. And finally, Basel III imposed 2 key liquidity ratios for big institutions. The first is a short-term one, the LCR, or liquidity coverage ratio, for banks to survive a 30-day acutely stressed period with their liquid assets, and also a 1-year net stable funding ratio, which is about keeping stable funding sources so that you have more liquidity available than the liquidity required in the long term. So as we see, the biggest institutions in the world, such as G-SIBs, immediately have certain surcharges, such as the countercyclical capital buffer, or CCYB, and also a G-SIB surcharge, for example. But because of their size and their interconnectedness, they also have additional measures, such as leverage ratios and liquidity ratios.